Hello everyone and welcome to my YouTube channel. In this video, I'm going to talk about how to avoid 5 beginner's mistakes in the stock market. In 2020, a lot of people started investing in the market and they made good amount of money. But since 2021 rolled in, many investors are actually underperforming the S&P 500. So in this video, I'm going to talk about some of the mistakes that these new investors are making and how you can avoid them. So let's get into it. Mistake number one is not doing your own research. Many people, when they first get into the stock market, they just simply buy some ticker symbol. They don't really understand the company behind it, the financial situation of the company, and their business model. So you have to be careful. When you are buying shares of the company, you're actually owning a part of the business. So you need to understand what that company does. And in terms of understanding the financial situation of the company, there are many websites that you can go to and look at the financial health of the company. Yahoo Finance is one, and it's completely free. There are several other websites that you can use for this purpose. Mistake number two is not knowing the investment strategy upfront. When you're getting into the stock market, you need to have clear goals of what exactly you'll be doing, whether you are investing for long term or you'll be doing short term trading. There's nothing wrong with either or. I personally do both. Most of my investments are long term, but about 5% of my portfolio is reserved for short term trading. You need to have clear goals of what exactly you are trying to do. What many new investors do is when they initially get into the market, they would just buy a bunch of shares from different companies. And if the share price goes up, they'll quickly sell, take profits, move on to a different company, and there's a very good chance that they'll lose all the gains in that new investment. On the other hand, if the share price goes down, they'll either panic sell and take in a huge loss, or they would just hold on to a risky investment for too long and keep on incurring losses. What you should do really depends on your investment strategy. If you are an investor in a company for the long term, then short-term price movements should not bother you. You're really holding on to the long term, and even if the share price goes down for a couple of months, you can just hold on to it. There's no point taking any losses. On the other hand, if you are a short-term trader, then you need to have stop losses in place and you need to be careful of how much loss you are willing to take. Mistake number three is taking too much risk. With the popularity of meme stocks, many people are just getting into the market and they're buying all these risky investments. And they want to quickly convert $1,000 into $100,000. Problem with that is it doesn't always work like that. Yes, there are a lot of people who made money with GameStop and AMC. I personally did it as well, but it doesn't happen every day. You have to be careful of what you're investing in. What you should do is reserve 1 to 2% of your total portfolio for these risky bets. And if they plan out well, then yes, you can make good amount of money. But even if you lose all of your investment, you still have 98% of your portfolio that can easily cover for these losses. I personally keep only 1 to 2% of my portfolio, and every time it goes above that, I always sell something, take profit, and still keep 1 to 2% of my total portfolio in these meme stocks. Mistake number 4 is chasing stocks or fear of missing out. Sometimes we like a company so much that we really want to buy their shares, no matter what the share price is. And sometimes it's the other way around. We like a ticker symbol so much that we really want to buy into it. This could be because of family and friends that are talking about it, people on social media are talking about it, so we really want to get into it. Problem with that is many times this actually backfires. If you like a company but it's been trading at a high valuation, then you should wait because eventually you will get your chance to buy the shares at a fair price. On the other hand, if you're really into these short squeezes and meme stocks, then you have to be careful at what price you are getting into that stock. Sometimes the stock price has gone up so much that you have really missed your boat and there's no point chasing it because eventually you will lose all the money. Mistake number 5 is not setting realistic expectations. When people get into the stock market, sometimes they want to make as much money as possible in a short amount of time. It doesn't work out that way. Of course, there are people who made money with AMC and GameStop and they made millions of dollars, but it doesn't happen every day. You can't just buy call options that are expiring at the end of the week and start praying that for some magical reason, the stock price goes up and you can make 100-200% return on a daily basis. If you look at the returns for S&P 500 for last 50 years, it's about 8%. And many day traders don't actually beat that. So if you are already making more than 8% on an annualized basis, then you are already beating the S&P 500 index and you are doing pretty good compared to many other people. On top of that, if you have 1 or 2% of your portfolio invested in all these risky bets, and even if one of them turn out well, you could make quite a lot of money, but you have to have realistic expectations. That's all from this video. I hope you got some value out of it. If you liked it, smash the like button and subscribe to the channel. Thanks.